So yes, this is going to be buying a put. This is the collar. So you buy a put and you sell a call around an underlying you have. Now, you don't necessarily have to have an underlying per se. You could have a portfolio and do this using like the QQQs or the SPY. You know, it's really, if you're going to use those ETFs, it's going to be really a conversion because you don't actually own the S&P 500, right? Well, some of you might own the ETFs. A lot of people, a lot of advisors, financial advisors are actually just putting SPY in a lot of people's portfolios because it gives you that type of diversification, especially if you have a smaller account value. But in that, a collar is around specifically an underlying, and a conversion is really to as a directional type trade, really, and it would be a bearish directional trade. We're going to more so talk about the collar because I'm assuming most of you out there, besides Banu, who said she's got everything in cash right now, this would be based on a directional assumption to the downside, and that would be using conversion. Mark Cuban actually made this collar famous because if you guys remember back in the day when he took what was it, broadcast.com, I think it was, or broadcast.com public, and then Yahoo bought him out for $5.5 billion or something like that. Well, most of that, a lot of people don't understand, a lot of that $5.7 billion came from Yahoo stock that he acquired. And Yahoo was trading at basically all-time highs. And part of the prerequisites with him getting that amount of stock was that he couldn't go out there and just sell it tomorrow. So he had to hold on to it for a certain duration. I don't know what that duration was, maybe sometimes 6 months to a year before he could really start selling it out. Well, he wanted to lock in his profits. And so he took this option strategy and went to the CBOE and started putting on these collars, or a conversion really was what it was called on the floor because they, were doing it as a conversion. He was doing it as a collar, right? Because when he was putting it through to the floor, he was buying a put and selling a call. He wanted to get cashed out. He wanted that stock to get called away from him if it reached a certain level. And he didn't want to lose any money from where he got into this position if it went below a certain level. So he was giving up a huge edge to these guys on the floor because he was doing so much quantity that these guys just kept repricing it. And he had to give up a huge edge. And believe it or not, the guys on the floor were actually laughing at him. Alan seems to have lost sound. Has anybody else lost sound? Future reference, one thing I forget to say sometimes is if you do lose sound, you guys, you have to usually log out. My audio is showing that it's coming through. So I'm hoping you guys can hear me. Sound is okay, D says. All right. So, it's not going to help out Alan, but, in the future, if the sound goes out, usually it is a GoToWebinar problem. So these guys were like laughing at him because they kept changing the prices. Well, at the end of the day, that was the high, all-time high, basically, in Yahoo. So who got the last laugh was Mark Cuban, and eventually he couldn't get out of that stock, quote unquote, by selling it, but he could get out of it using the options, which is exactly what he ended up doing for at least a lot of it. Can hear and see. All right, great. Somebody else said, it's perfect for owners of an IPO through a lockup period. Absolutely. And that's kind of what happened with him, is he got bought out and was put up into a lockup period. So they can't sell the stock for a given duration. And a lot of cases, yeah, you're right, Chen, it is like 6 months. His might have been, he could sell so many at 6 months, so many at a year, and so many at different durations. and he probably did the collar in and around that. I wasn't on the CBOE. I was on the Chicago Board of Trade, which was just across the street. But he made it famous, and everybody was talking about it after he did that. And the guys thought that they had pulled one over Mark Cuban's eyes, but in the end of the day, they got left with holding the bag there. All right, so let me go over a couple of things really quick. My name's Eric Wilkinson. For some of those you who I see are new to this webinar, I haven't recognized a couple of names out there. I used to do stuff on CNBC, mainstream media, Wall Street Journal, stuff like that. I actually started trading out in college with some money I had earned with a psychology degree. Decided to switch it over to finance. And after graduating from school with a finance degree, I moved directly to Chicago. Literally just packed up in the summer, moved straight up to Chicago, walked onto the floor of the Board of Trade, and just begged for a job until I found one as a runner like these guys down here. And then ended up moving up into the pits and trading my own money ever since. So I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. And now I've got another feather in my cap. I'm trading through these crazy times that we're seeing right now with volatility going through the roof. All right, please take a moment to go over this disclaimer. We need to make it very clear to you guys, there is a chance that you could lose a lot of money trading or investing for that matter. And we are an educational company. I'm not here to try and get you guys to lemming off the cliff with me. I hate the herd mentality. I do not agree with when people are giving trade recommendations, because at the end of the day, I don't think that they know any more than you. And they might say that they do know more than you because they've got all this technical analysis mumbo jumbo going on. But at the end of the day, directional assumptions are, that old adage, what assumptions say. So you guys might very well have a better grasp on directional assumptions at any given time. So I don't want you guys to do necessarily exactly what I'm doing, because your assumption might be better than mine. So keep in mind, we are just trying to teach you guys different aspects about options that you can then go and implement in your portfolio in your own way. And remember, past performance of any trading system or methodology is not necessarily indicative of future results. Kim, hey, Eric, great to see you again. I'm a big fan. Thank you, Kim. I appreciate the kind words. All right, so with that out of the way, let's go move on. You can follow me on Twitter at Wolfman's blog for all kinds of snark and hopefully a little bit of trading wisdom. I usually do daily market commentaries in the morning where I talk about all my trades, win, lose, or draw. Right now we're talking about the losers a lot more than we're talking about those winners, because the winners come and go, you guys. There's not a whole lot to learn from the winners, but the losers, I talk about how we're staying mechanical with them. I mean, if you guys have a portfolio right now, whether it's a 401k, an IRA, a Roth, or just a trading account, you're probably seeing some major swings going on in those portfolios, as am I. So I talk about what I'm going through, how I'm managing that risk, how I'm trying to lower my cost basis, which is something I highly recommend, is trying to lower cost basis on what we paid for these underlyings on any given moment. All right. Also, follow us on Pro Trader Strategies. We're throwing out a lot of content there that you guys can find useful. A lot of that, it's obviously free then. But one thing with our paid stuff, you guys, is we put that in a chronological order or in some kind of logical order so that it is kind of expanding. So we'll start you out slow and build it up so you're not getting lost. So my courses are specifically designed that the further you get along, I start making assumptions that you guys have already watched some of the earlier ones or some of the more basic options course material, and then we build up to that, all right? But feel free to ask questions throughout this webinar. I'm more than happy to answer anything because I want to make sure you guys are clear of concept. If I start talking a little bit highbrow and maybe getting over some of your heads, reach out in the questions box, ask me a question, because I want to make sure you're getting that answer. And if you're asking a question, somebody else is probably having that same question as well. So a little bit, we kind of already went over this a little bit, the conversion. It's basically you are buying an out of the money put and you're selling a short out of the money call. Now, obviously with the conversion, there is a lot more risk to this. If you have it with the underlying where you're long that underlying, you would be buying the out of the money put and selling the out of money call to finance. We're trying to finance this put for as much as we can. If you go out there, if you're doing stops right now, you're getting clipped on stops left and right. All right. You don't get paid for that. Whereas when you're doing a put, I like to say when you go out there and you're buying that put, it gives you a little bit of wiggle room. It allows you to stay in this trade a little bit longer and let everything kind of work itself out. Problem with buying just a put is that increases your cost basis. I'm constantly trying to teach you guys how to lower cost basis on these underlyings, and just buying a put will make you have a higher cost basis. So if you bought a stock at 100 and then you went out there and bought a put for $1, well, you're increasing kind of what you paid for that underlying. You know, now your break even on that underlying is 101 because you got to make up for what you paid for that put. Well, with this, we're going to be selling it out of the money call to finance that put. So it protects us to the downside. Yes, you will have that stock called away from you if it gets to a certain point, but you know, that is the trade-off there. This is something where we're going to try and lock in that profit in a sense. So if you've seen a nice run in something, maybe it's Tesla, right? You've seen that nice run. You've owned Tesla since, 100 or 25 or whatever. Now you're up into the stratosphere with that stock. Well, you might want to be protecting some of that gain with this strategy, all right? Especially in these volatile markets. I'll talk about some of the problems with implementing this strategy in volatile markets like we're seeing right now, which is very out of the ordinary, but it still comes in pretty handy. All right, our max profit is that short call minus where we bought the underlying, right? So basically, wherever you got long that underlying to that short call, plus the premium you received, all right? So I'm making a little bit of an assumption here because plus the premium is assuming you got a credit for it. Now it is minus the debit paid if you're paying a debit for this strategy, which you might very well be paying a little bit of a debit in this strategy if you're trying to get pretty close to where the underlying is currently trading because you're worried about it. But so keep that in mind. It's a short call minus that underlying. So, if you had on let's say the short 125 calls and you got long this underlying at 100 and you got a credit of say 25 cents. All right. So basically it's 25 is your max profit on that. All right. Would you own a conversion in the previous slide? In this one here, not really sure what you're saying. Would I own it? You would be long the put. So if you're just short this call outright, you're going to be losing money if the market goes straight above that short call. Why would you own it? Just as, if you didn't have anything in your portfolio, I'm assuming. Well, in a market like we're seeing right now and people are very worried about it, you're bearish. You're very bearish on this. So this is a very bearish strategy, right? You are not expecting the market to go up. You are very bearish. You think this virus is going to kill everybody, or at least put the entire globe into a massive recession. Something like that. Just trying to give real world examples right now. I'm not that concerned. I think the media is blowing it out of proportion, but I could absolutely be off my rocker. Who knows? All right. Your max loss on this. Yes, your max loss on this is going to be the underlying price minus that short put, or minus a long put, minus the premium. Okay, so that's going to be your max loss, is if the underlying, because remember, this long put is going to start making up for that loss in the underlying. So as soon as we clip through that short put, you can think of it as that you are putting that stock to somebody, right? Because you're long the put. When you're long an option, you have the right, but not the obligation to fulfill that contract. And when you're getting long a put, you put your stock to somebody at that strike. And you still get to keep that premium if it's a credit. All right. So that's assuming it's a credit. If it's a debit, then you have to say it's plus the debit. All right. So you're going to have a loss from where that underlying is. So if, again, that example, if we were long the 100s and we had the 85 puts on there plus a 25-cent credit, 25-cent credit, right? Then our max loss is that $15 minus the credit. So our max loss is $14.75 then, because we get to keep that credit. Raj, I see your question. Let me just do this last one. I'll flip over to the, we got a slide for the conversion coming up here soon, and then I'll read your thing. All right, the break even is that underlying price plus the premium. So if we are, minus the premium. So remember, this is assuming we got a credit. So if we have that underlying at $100, we bought that underlying at $100 and we got a credit of that 25 cents, right? I get to keep that credit. So I've lowered my cost basis. You hear me talking about, I like to do this strategy for a credit because I'm constantly trying to lower my cost basis on this. So now my break even on this is $99.75 of where I bought it. If you do this for a debit, the problem with paying a debit is that you've increased your cost basis. So it's plus that. So now my break even would be $100.25. All right. And then the conversion, here is your max profit. A little bit tongue in cheek here because I'm assuming you have something in your portfolio that you can hedge. But if max profit is the market goes to zero, so wherever you got those calls, or those short puts, wherever your long put strike is, it's there to zero, all right? And your max loss is basically your short calls, and it goes through the roof. So anything after your short calls is your loss potential, every single tick, all right? And the short call strike plus the net premium is your break even. So wherever your strike is, just to say that if I am short the 100 calls, right, and I did a total collection of 25 cents, so plus 25 cents, my break even is going to be at 125 because I get to keep that credit. That's already in my pocket, so you add that in there. So the conversion is the two option trades on the same signal like the SPY without the underlying stock or equity. The short put or long put, it's a long put and a short call, equal distance from the equity. Well, yes and no, Raj. Right now, there's so much put skew, meaning the equal distance puts from where the underlying is, you're having to see those premiums be worth a lot more. And when I pull up the trading platform, every example is there's so much put skew that when we're trying to do this strategy for a credit, we're actually having to sell those calls a little bit closer to where the underlying is currently trading, and the puts are a little bit further away. So there's a lot of skew, and skew means like a normal bell curve would kind of look like that, right? Right now, if this is the puts and this is the calls, which is positive, and these are the puts on the negative side. I'm not saying we're buying calls and selling puts, but what I'm saying is puts are considered negative going down. Right now, what we're seeing is basically a bell curve like that. All right, where the going to the downside is that side, and going to the positive side is that. So there's skew down this way. So basically, what they're saying, when you have a bell curve and stuff like that, you have your standard deviations. Well, your standard deviations are looking like that, and on the call side like that. All right. Conversion would have ruined many accounts if it was on Tesla when it went through the roof. Yes, absolutely. Well, that's part of the reason why Tesla did go through the roof, was the fact that there were so many shorts out there. And once they got, on their heels, that they got run out. Is that a bearish sentiment or implied volatility? Right here, this skew is being caused by implied volatility, or the volatility that's going on. Yeah, and Tesla's becoming a real car company with, that are very tech savvy. I don't know if they're really worth, though, as much as the big five put together. It seems a little bit ridiculous, but who am I? I'm just glad, Ken, that I got out of my short Tesla right after those earnings came out, and I was like, I'm out, because that's when it went through the roof. You're right. All right, so I have some rules that we talk about. When we're building an option strategy, we need to talk about the right strike. What I'm looking about, slide 12, not advancing. Are we there now? Did we advance, Kevin? All right, so page 13, that's all right, good. So the right strike, I'm usually looking at the 16 delta because that is one standard deviation move. So that's basically equal to one standard deviation, all right? And why we're trying to get out there is there's only a 16% probability that I am going to get clipped on this, all right? It's only a 16% probability that we'll go through that delta. Now, the probabilities are the probabilities. So a 16 delta is also equal to a 16% probability. All right. It's a 16% probability of being 1 cent in the money at expiration. All right. Hopefully that comes out okay on your guys' end. So that's what it's saying. It's 16 delta is a 16% probability of the underlying being 1 penny in the money at expiration. And Banu is all over it. 16, floor trader hack is the 16 delta is also equal to, your probability of the underlying. So when we have that, let's just say we've got the calls over here and the puts over here, and I've got my 16 delta call, which is, let's just say, a 16 delta call. And the put side, we've got a 16 delta put. Basically, the probability of the underlying coming down and clipping me is equal to 2 times the delta. So 2 times the delta equals your probability of touch, all right? Probability or whatever. It's the first time I've ever written that out. All things can't be equal. So, for instance, the underlying, if my 16 delta on a chart is up here, 16 delta call is up here, probability of coming up and hitting that is equal to 32% probability of being touched. It might go through it, but then coming out, right? It's only a 16% probability of staying up here, all right? So that's why I'm trying to pick that. The probabilities are in my favor. And despite the fact that we're seeing volatility through the roof right now, keep in mind, when their volatility is high, those probabilities, volatility determines really delta, or, depending on if you really believe in Black-Scholes pricing model, right? But probability gets stretched out. So right now, you know, with really low volatility, you talk about that standard deviation curve. This is what you would see with really low volatility, right? Your standard deviations are going to be pretty tight. That same underlying and really high volatility, you can think about it as volatility kind of pushes down on this bell curve. So the bigger, this would be very little volatility block, right? Well, if I have a big, huge volatility block, and this is vol now, and it blows up, well, my curve ends up going like this and kind of getting squished out, all right? Gets pushed down. So now my same standard deviations are further away, okay? You know, so this might be the one standard deviation, and now this is your one standard deviation. Okay, so volatility, you know, as it expands, squishes down that bell curve. So your probabilities end up getting wider. Like right now, you know, volatility where it's at is pricing in 3% moves. And I'm talking about the VIX. VIX being up in the 40s is pricing in a basically 3+ percentage point move in the underlying, like the Dow Jones, the S&Ps. And guess what? We've been getting that on a daily basis. All right. So picking the right duration. So we got the strike. We're looking at that as being the 16 delta. I usually like to go pretty close to that 35 days to expiration. Days to expiration, right? So the reason why is I don't want to be in this forever. I'm trying to lower my cost basis on this, right? That's my main objective. Yes, protection is a huge thing. I'm going to protect myself to the downside. And especially if my stock, we're going to look at this, I'm going to be far enough away where I can put these calls very close to where they were on the highs. And I would probably be very happy to get out of my stock in the next 45 days if we were at all-time highs. So that's why we're trying to play that. All right. You give the bell curve a MASH mammogram. Exactly. Rick, I should have looked at your name before I said that, because I always know you got some kind of crazy snark I got to be careful with. All right. So we're going to be looking at the 35 days to expiration. Could you talk about the synthetic collar when you are short the stock? Like you're talking about the reverse of it. If you're short the stock, yeah, I'll do that towards Raj. Remind me to do that at the end of the webinar, and I'll go over that real quick. All right, cool. So 35 days to expiration, because we are getting a credit, hopefully getting a credit. We want to take advantage of this. Now, if somebody said, and you own this stock from an IPO or something like that, which is probably, you know, slim and none of the people that are in here, but just in that case, you know, if they said you got to hold it for 6 months, right, before you can start selling it, well, then I would use 6 months days to expiration, right? So I would be using something that is, you know, 200 days to expiration, right? If we had to follow along with that. But with this, especially right now with this kind of volatility, I want to be inside of here. This is the sweet spot, right? I'm going to be getting a credit, hopefully, very small credit, and I'm trying to lower my overall cost basis while protecting myself from a black swan event, which, you know, everybody starts seeing that the global slowdown is imminent, and the market's just going to crash, right? That protects us from that black swan event. Now, with what's overhanging us right now, the markets to try and get to that all-time highs is going to be a heavy lift. So very well could be a good time to implement this type of strategy around a portfolio, all right? And the right environment. Now, I usually talk about this. We got to be worried about volatility, not necessarily. Vol's going to get, usually I talk about vol here. We're going to be able to pretty much offset that volatility coefficient. One thing with this, though, is our strikes with, if we have low vol, remember our strikes, you know, if the underlying is trading right here, our strike location is going to be much closer to where the underlying is. With high volatility, which is what we were talking about with that squished standard deviation curve or the bell curve. With high vol, you know, if the underlying is trading here, our strikes are going to be much further apart, right? And that's probably a good representation of where the calls are versus the puts, where we've got that skew to the downside in the puts. All right, so we want to be worried about the downside when we're implementing this strategy, and we're pretty bearish as to what's going on in and around this underlying, all right? Especially if you're using the conversion, that means you're just putting on a directional trade. You need to be very bearish then. All right, picking the right underlying. I talk about this when we're talking about we want a tight bid ask. So we'll start pulling up the platform more often now. Let me pull this up here. We're in the wrong one, so let me pull this over here. Now, we're after the market's closed, and we are at, when I talk about high implied volatility, this is what I'm talking about. You can see in the last 52 weeks, I probably pull this up even longer. We could go like 3 years or something like that. It's probably the highest volatility this market's seen in quite some time. I don't know why everything is acting so slow right now. Let me see if I can do this and get it to pull up. All right, doesn't want to pull up that chart. Oh, what is going on all of a sudden? Anyway, so this volatility is absolutely through the roof right now. As you can see there, let's see if it'll catch up now. And let me pull up the 3-year chart. There we go. So you can see even in the last 3 years, this volatility hasn't been there. So it is astronomical at this point. So you can imagine what implied volatility is telling me right here is that volatility is at the highest level, which means that we've seen in the last 3 years, which means it correlates to the premiums. These premiums are the highest premiums for options that we've seen in the last 3 years. I can probably pull up the 10-year chart and it'll still be at the highest levels. So it's just absolutely huge, which means we're going to have to get a little bit further away than where the underlying is trading. Having said that, when volatility comes out, you know, those probabilities of us, even if the underlying stayed right here, the probability is of us getting clipped on our puts or our calls become much less, all right? But one of the things we talk about when we're buying and selling strategies is we got to worry about volatility. Well, volatility, you can see, is 0.05 over here, and over here the volatility, well, I'm not looking at the equal strikes, so let's look at this one here. So I've kind of highlighted it. And the deltas are about the same now. So we got a 32 delta and a 35 delta. When we're trying to pick the same strikes, or the same, not strikes, the same deltas, you're going to see that our volatility is offset. So it's not going to hurt us. We're selling a call, so that makes Vega negative, meaning if Vega goes up, that's going to hurt us. But we're buying a put, which means our Vega is positive. So if volatility goes up, it helps us. So those two are going to offset. The deltas are going to offset also. I'm buying 32 delta, which makes that negative. I'm bearish. And I am selling a 35 positive delta, which means a negative plus a positive is a negative. Gamma, theta, all of those are going to pretty much offset, all right? In this case, it's not. Theta's because there's put skew is going to be a little bit greater. But we're going to try and build this for a credit, so we're not going to have to worry about that so much. Las Vegas Sands. I'm not getting this collar, and I'm not getting this. Is the collar better in low volatility or in any environment? Well, in lower volatility, we are going to be closer to where we're not going to be able to get the same premiums, but we are going to be a little bit closer to where the underlying is trading. But like I said, the probabilities are the probabilities. So we're offsetting the volatility, but having said that, with the premiums and stuff like that, a 16 delta is going to be much further away. Now, is that good or is that bad? Well, on the call side, it makes it a little bit better, but on the put side, it means our risk is going to be a little bit more to the downside. I can't really say is it better or is it worse, because they kind of have offsetting, right? So in high volatility, because that 16 delta I'm looking at is further away from where the underlying is, well, that helps us because we can make up a lot of spread to the upside. But having said that, our trade-off is that we have more risk to the downside when that volatility is high. Yes, you can absolutely, in something like this, do the 35 deltas, like in this, like what I have highlighted here. But just keep in mind, you only have a 35, you only have a 35% probability of being in the money in the next 46 days for these calls. But what Banu mentioned is that we have 2 times the delta is our probability of Las Vegas Sands in the next 43 days coming up and hitting 60. All right. You could get whipsawed if you're doing these 35s if the market moves up. That's why you have to be worried about the downside with this strategy, right? It's a bearish strategy. You're trying to protect your overall portfolio. Now, having said that, if I was long, 1,000 or 500, Las Vegas Sands, even 200 Las Vegas Sands, and I want to protect that, if I was at all worried that, like in my eyes, I would be worried about this kind of blowing over and we get a V-shaped recovery. Well, in that case, then I might only do one of a one lot in the options, which is equivalent to 100 of the underlying. So I would be hedging half of my exposure in Las Vegas Sands. Same for if you were long a huge portfolio. I'll talk about that here now. If you're long a huge portfolio, then, I'll show you how to come up with your pricing on that, or how many quantity you'll do in just a second. But picking the right underlying, what I talk about here is any stock that is less than $100. We need our bid to the offer during open market operations to be less than 10 cents wide. Now, right now, you guys, you're not going to probably get very many that are fitting this rule. That's usually during normal open market operations. Right now, we are seeing exceptional volatility, and when volatility expands, they will have a tendency to get a little bit wider. And we are after the close, and nobody is leaving option trades in there after the close. Like normally in Apple, we would still see this even after the close being, less than 10 cents wide to the bid ask, despite the fact that it's a $300 stock. All right. And on any stock, though, that is over $100, you move the decimal 3 ticks to the left, and that's how wide the bid offer should be. So in this case, 29 cents rounded up to 30 cents. You can see that it's not fitting that rule. Why? Because one, we are after the close here. After open market operations are closed, people are canceling their orders. Nobody wants to take that risk. During open market operations, they will be a lot tighter, and they would probably fit that rule of being 30 cents, even though Apple, in normal historical terms, when we're seeing volatility, fits that rule almost at any time, even less than 10 cents wide for the most part. So stocks over $100, move the decimal 3 ticks to the left. During open market operations, we should see that fit that rule. And then any stock that is under $100, then we need to be able to say that it needs to be 10 cents wide to the bid ask. Right now, you're going to have to fudge that a little bit. I would say it's still a yellow light. XOM during open market operations was like 15 cents wide. Apple will probably fit the rule, but for the most part, you can fudge it just a little bit right now in these types of markets. Your ETFs, like the QQQs, the SPY, SPX, they're going to fit that rule. So because there's so many eyeballs on here that it will tighten up as it's going on. What about the margin requirements on this trade? It must be a lot. You are going to have the margin requirements if you own that underlying. Okay. If you're just implementing it as a trade and say, for instance, an IRA or something like that, where you have to do cash secured puts and the short calls, yes, those margin requirements are going to be pretty big. But in and around the underlying, when you own that underlying, the margin requirements are not going to be that dramatic. Sell weekly 35 deltas to offset the cost of the April 35 delta puts. Collect better theta decay on the calls. You could try to play around with that. That's something that's a good one. We can kind of look at that towards the end of the webinar and see if that works out. Can you try to do an example? As a matter of fact, yeah, give me 1 second here. Example of the SPX or the QQQs, we absolutely will. So usually when I kind of round off with these slides, then I tell you guys to throw out some examples, and I'll use that for sure as an example. All right. All right, so portfolio value. So this is what we're looking at. If you're doing the collar around a portfolio, say you got a portfolio of, your stocks are worth $100,000. Well, you've got a pretty balanced portfolio, and you have equivalent to something like the SPY is around 300. Basically, you're going to take that mathematical equation and figure it out. So, for instance, if your stock was trading at that strike, then that's how you're going to do it. So we can do, we know we got the 300 stock times 100, right? So basically 30,000. And we're going to say 100,000 divided by that 30,000. So it's equivalent to around 3, right? Well, I would suggest not. The kids just came home from school. Sorry about that, you guys. So it would be, if you wanted to completely hedge your portfolio, you would do about 3 of the SPY for $100,000 portfolio. And keep in mind, SPY, you need to make sure that your portfolio is SPY weighted in a sense, like you have a lot of the stocks that are in the SPY. If you have all blue chip stocks, you're going to be looking at something in the Dow, right? You're going to be wanting to hedge with a Dow product. If you are tech heavy, you're probably going to be looking closer to the QQQs for this example, right? And if you have $1 million portfolio, you probably wouldn't be using SPY. You'd probably be doing something like the SPX, all right? So this is your value. So if it's XYZ, I'm looking at XYZ here, and I own the stock, my stock value is $100, then I'm going to be looking at that, all right? That makes sense? All right, so this is where I throw it out for you guys to give me some examples. The first one I saw was QQQ. So let's pull up the platform here and just look at the QQQs. It is a defensive play. Absolutely. I'm long, tech stocks, let's say. I've got Apple. I've got, I'm drawing a loss on who all's in the, but basically tech heavy here. All right. So this is what I'm worried about in my tech heavy portfolio, which could get hurt, in this type of environment. So with the QQQs, I'm going to be looking at the April. It's closest to that 35 days to expiration. 15. You could look at these a little bit closer, but with the volatility the way it is, that we could be looking at the 225s or something like that. But I'm going to go out here and say you can look at the charts too. Yes, absolutely. So you can look at the charts and say, well, if it got back up here in this type of volatile market, then I would be happy to get out of this. And if it slammed down here, then, started really selling off closer to the point of control or something like that, I want to be out well before that ever happens. So we could go out here and look at the 16 delta. You can see that the 16 delta, I want to talk about skew real quick. Sorry. So right now we have this underlying trading right around 111, right? So let's just say we go $5 lower. So we go down to the 106s. Those are trading right in between $8.60 and $8.90. So now we go $5 higher and look at this 106s or the 206s, and you can see where I'm getting paid a lot less for that. $5 up, $5 down, right? Right? Does everybody see that? That's where I'm talking about skew. These equal distance away, $5 up to the 216s. I'm only getting, I'm only getting a strike of somewhere around $7.40. And then if I take $5 down, the 206s, I'm getting paid almost $1 more, a little bit better than $1.50 more, right? But you can see that the deltas are different right here. These are the 40 deltas. These are the 43 deltas. So the deltas are basically the same, but the pricing, the skew is getting skewed out there. And this pricing is a little bit off. I'm sure the deltas would change during open markets. That seems a little wanky to me right now. Higher cost for the puts versus the calls means there's skew to the puts, correct? Could we not buy a put just above resistance and sell a call just below support? You think you got that wrong, backwards. Support would be on the downside, right? Resistance to the upside. But yes, you could say, for instance, you could buy the put just below the support and sell the call just above the resistance, which is kind of where you would be thinking yes. So let's go over here again. I'm looking at the 16 deltas. So for instance, I'm probably, in order to do this for a credit, I'm going to have to fudge a little bit and probably go down a little bit, say that the 229 calls to sell those for $1.98, and the puts are going to be way down here to buy. So you can see that that distance is a little bit off from where the underlying is trading. So that's one of the downfalls of the skew being to the put side so much right now. It's basically going to hit the 52-week low and I'm out. All right. And to the upside, I wouldn't even be getting back to the all-time highs. So that's one of those things with this strategy. We would probably end up wanting to give up a little bit of money to hedge a portfolio. For instance, something like this trading around 200, I probably, or a $100,000 portfolio, want to do maybe 2 of them or something. So I'm probably going to have to change this and say, you know what, I'm probably, I don't know what just happened there. Went to, oh, that's what happened. It's because I did this wrong. So, because I changed my quantities. So the 229s I'm going to sell. So I probably want to come in a little bit better than that. Maybe give up some debit for it to protect myself a little bit better. Yes, I got what you meant, Raj. but I read it out without reading it first, and I wanted to make sure everybody was clear of concept before we went on. So there's a little bit of skew there. We could definitely, if we wanted to protect ourselves a little bit tighter than that, you can definitely start looking at what I think it was Chen was talking about, going a little bit closer to the duration here. And we could say something like we're going to be looking at the, if we were really worried about this, say the 16 delta here, selling the 225s, and then coming down here, and we'd probably be buying something like the, where I get $1, like the 182s or something, paid just a little bit of a delta, a debit there. That makes sense. Something else. What was the other one that you were talking about, going with different? Can you adjust these on a day-to-day basis on how much the market behaves? We have having 1,000-point moves in both directions these days. Well, yes. If you're getting a credit and you can get out of that for a debit, say for instance, earlier today when I was looking at this strategy, of course, before when I go through and I'm getting prepared for these webinars, I was coming up with different strike locations for things, and literally every example I was coming up with for these, I was doing them for credits, and then 5 minutes later, it was basically I could have gotten out for a debit because of that big, huge swing that we saw in the markets today. So, something like today where you have that big move up, early on in the morning, you had a big move, a big move being down 800 to only being down 400 or something like that. And you start worrying about the downside, you start hearing about more cases or whatever, more risk to the, you could put that on. You saw it come in as a profit. You think tomorrow, you know what, they're going to forget about it. And the market's going to rally another 1,000 points. Yeah, you can absolutely do that. And yes, you could roll it over if you are able to. I wouldn't consistently do this necessarily, roll it at debit, 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 right? Because you're increasing your cost basis there. But if you were doing it for a credit, yeah, absolutely. If you were doing it for a credit and you saw that credit dwindle to nothing or go into a debit, yeah, you can start playing that for the swings. Absolutely. Yes, absolutely. Earning income. Yeah, I'm always talking about this as trying to do this for a credit because I don't want to increase my cost basis. Because if we do this for a debit, remember, if I bought this as a collar and I bought this underlying at $211 and I do this as a debit, well, I got to add in that debit to what I overall paid for my underlying because it's a cost of doing business, right? If I'm doing this for a credit, then I'm lowering because I get to keep that credit no matter what. Even if I get clipped on my calls and it gets called away from me, I get to keep that credit, right? Or on the put side. So vice versa, if you thought that this market was overblown and you are short a stock, but you're worried about this snapback, maybe you're short the Qs because you think it's going to, crash, and that's your trade. But now all of a sudden, something happens to where you think the market's going to go up. Well, you are absolutely going to be able to. You wanted to get it called away. If, say, for instance, if the market came down to the point of control or something like that, wherever your theory comes from, you're going to get paid for taking the contrarian point of view, right? Because the put skew is there. So if you sold these puts, you're short the underlying. You want that underlying to get taken away from you. You sell those puts. Well, that $2.50 is going to get you a lot of upside, right? I'm going to be able to get much further away and still collect that nice credit. So that would be on if you were short this. We're doing the flip side of it. In this case, we're selling the puts because we wouldn't mind that underlying getting taken away from us. We're putting it to somebody. And then, the calls protects us to the upside. If it's all of a sudden our shorts start going through the roof, like for instance in Tesla. If you were short Tesla and this one worried about that upside, this would have protected you on that. That makes sense? Cool. Everybody got that? So right now it's a little bit wanky because there is absolutely so much put skew in here. It's forcing us to kind of take into account these bigger swings. But keep in mind, if volatility comes out, the probabilities of us getting clipped on these different strikes is going to come in quite a bit. All right. So probabilities are a product of that volatility. I have a stock I sold a covered call so I can buy a protective put and collar it. Yes, you could. Absolutely. Yes, if you've lowered your cost basis, absolutely you can do that. You can say that you're paying for it, or those calls paid for your protective put. Put is going to be far away. You're right. But, having that protection on, keep in mind, you bought the put, you have the right, but not the obligation to put it to somebody. And if the market comes down there, at least, it can go to zero, right? And you don't have to put it to somebody until it goes to zero or whatever. And if it goes down there, and it gives you a little bit of time to kind of be sane, you can basically hold on to it longer. A stop, if you had a stop in there and you were worried about it going below 193 or something like that, in this case where we would be selling it and buying these calls, if you were worried about the underlying going to 193 and you said, well, I'm going to put a stop in there at 193 because if it goes below that, then I want out. Well, that stop is going to get hit. And in these markets, you might not get filled at 193. You might get filled at 192 or something like that with, if there's a flash crash. You never know where those stops are going to get filled. But with the puts, you know where you are getting out. And if it goes down to even 185, QQQs go down to 185, and the next day it's back up to 196. Well, you're still in the trade. You're still long that underlying. You didn't have to get out. All right. And I would usually hold these, for at least most of the duration, to be quite honest, because it's going to take a while for you to get really paid on these, and you're getting such a little credit that it's going to not matter that much. It's more that you're taking yourself, protecting yourself. I'll do another one on SPX for all you that have big portfolios too. So delete this. So SPX, one of the things is we're going to want to move a decimal 3 ticks to the left. $3 is how wide we should see these markets. And you can see that fits this rule, right? That was my rule. Move it 3 ticks to the left, $3. So you can see that it fits that rule even after open market operations. I want to look at the longer durations. Which is going to make it really wide, you guys. All right, so the 16-ish delta, first 16 delta I'm going to see here is the put, so I'm going to buy those, and I got $45 to burn, and $45 to buy, probably around this one here is, oops, I want to sell those, sorry. I get $1 credit. All right, so you can see it's a 29 delta versus the 16 delta also. And that's because of that put skew going on. My stock has no options beyond 2020. Why is that? I'm not sure. I'm not sure, Raj. What platform are you using? So something like that. Now, look, 3185 is, basically where we started. 3185, I mean, that's seems plausible, right? And to the downside was, what was our strike? 2635. So again, the problem with 2635 is below the 52-week low on that. So it's a lot of downside on this. So I'm a little leery of implementing these collars around this type of environment that we're seeing right now, because there's so much put skew in there, you guys. Usually I have much better examples. And even though, I like to do this with a little bit lower volatility, maybe mid-range volatility in the underlying, where we're talking about an IV percent of about 50. Well, if I go to something that has, let's say, targets close to a 62 IV, so, you think that's mid-range. Well, look at this. We are still at the 52-week highs for the most part in volatility for target. So, we're still seeing the highest premiums we've really seen in the last year or so. So premiums are still elevated, and it's going to, and that's basically because everybody is using both hands to buy. Both hands means using huge quantities to buy these puts. So you can see here, even equal distance away, 105, go down $5, $2, 105 to the upside. That's a little strange. There's call skew on the, there's call skew here. It's pretty wide on those. But it looks like there's a little bit of call skew going on there. But then again, I think Kroger, any of these, Costco, these guys are going to do very well because people are buying stuff off the shelves right now. Do you address selling naked puts in your paid programs? Yeah, I talk about every single strategy. And if you guys see a strategy I haven't covered, please reach out to me because I will cover it. I think I've covered most of them anyway. What about going out in time to the November elections? You absolutely could. That's what I was talking about. I don't see the November ones because they're going to start going to the quarterlies out here. But you could definitely do that if you were worried about the elections. I might wait a little bit longer and implement this around those elections closer to that, because we could go anywhere in the short term. So I'd probably be looking to hedge that risk then. Hedge this risk now, hedge that risk then. All right, so you guys, Raj was talking about this. This is our offer that we're doing right now. This is the Premium Options Education Service. This isn't just a course, you guys. This is $97 a month. You guys get full access to me. You can talk to me about all your trades. I will give you what I would do. I can't give you the advice as to what I think you should do, but I can tell you how I would tackle that. So you basically get the trading workshops, free priority access to the trading workshops. That's $396 value. Membership trading courses, $1,500 basically. And these are all of the things that you will get with this. Basically, you're going to get all of these, where we put these in order where it makes sense, where you guys can build up to it. So you can basically check them off. After you've seen it, you want to skip to that one, you can watch that one, maybe you go over here and watch that, and you can check them off. So all of these here, and I'm going to go through pages and pages of this, as you can see, and then we kind of build this up as we go along and make sure that you guys are fully understanding in different environments, different directional assumptions, different types of option setups. I might talk about the same short call or in two different sections here, but I'm talking about specifics in and around why that would work for something else. We're talking about different scenarios of that, short puts. Sometimes I'm talking about as a trade. Sometimes, like right now, I would be talking about, when I talked about implementation, is we are doing dollar cost averaging, or we're trying to add these. So you're basically getting all of hundreds and hundreds of webinars. It take you years to get through all of these probably. So you can get access to me. If you have an issue, reach out to me. I will absolutely answer you. And if I can't answer you in an email, I will try and get you guys on the phone to talk about it. So the link is over in the chat window, you guys. We have been going back and forth in the questions box. You got to look over there to the chat window. There's a hot link for it. Pulls it right up. Otherwise, right down here in the red, it is going to have to get punched into your URL. All right. So you get options for beginners, intermediates. We kind of build your education up there. And then we start talking about higher risk strategies throughout these different courses. So you're basically getting access to all the courses I've done. And for $97 a month, sometimes that's a little bit cheaper than buying the whole course, but you can take advantage of all these and kind of move along at your leisure. But the big thing is you guys absolutely get access to me. So I want to thank you guys all. Take advantage of that. Chat window, yes, chat window. And later webinars, I'll be drilling down on different option components when and where I find them appropriate. This is also the link, but again, you would have to pause the video if you're watching this on tape delay. And if you have any questions, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. And here is your final display. Yes. Yeah, please. Over there in the chat window. If you guys have learned anything, I try to teach this to make sense for you guys. That's what I do in all of those webinars. So I try and come up with different ways for you guys to remember this and the analysis that goes into it. Why, if you go online, yeah, you can get it for free. But, some of those guys, they're telling you to buy long calls. They're telling you to buy in the money long calls. And I absolutely rip that apart in my analysis. I'll go through that. I'll show you why that 55-65 delta call that's in the money is not better than the call strike that I'm talking about. All right. And I think I can pretty definitively debunk the in the money call buying theory. All right. That's all I got for you guys. Thank you guys all for your kind words. I appreciate that. Thank you, Raj, for the kind words. That's all I got for you guys. Other than, if you can't take that, take it easy. Thank you, Philip. Appreciate it. Bye for now, guys.